What is going on, Ape Nation? Yesterday, Ken Griffin did an interview, and this interview was over an hour long. I had the privilege of listening to the entire thing, and I'll tell you, it had some very good information in it, information that you're going to want to hear because it completely contradicts what we've been being told. And I will get right into that, but before I do, please don't forget to smash that like button just to piss Ken Griffin off, because that'll make the YouTube algorithm share this video with as many apes as possible, and he doesn't want that because he does not want you hearing this information. And for the love of God, if you're not subscribed yet, go ahead and subscribe because I drop content just like this every single day. Anyhow, enough of that. Let's go ahead and get into this video. Let me just remind you of this. On October the 18th, 2021, the SEC released the official GameStop report, which told us that GameStop and all these other meme stocks, but specifically they were talking about GameStop, did not experience a short squeeze. They called it a momentum movement. And the report gave us some criteria on what it would take for a stock to experience this type of momentum movement, the same momentum movement that GameStop and all of our other meme stocks went through. So let's go over those very quickly before we get into what Ken Griffin said. Number one, there's large price movements. Number two, large changes in volume. Number three, large short interest. Number four, frequent mentions on Reddit and YouTube. And number five, significant coverage in mainstream media. So this is the criteria that they gave us for a momentum move, and they defined the GameStop move on January 28th as a momentum move. They said it was not a short squeeze. So they're telling us that on January the 28th, we never experienced, or GameStop never experienced a short squeeze. It was all a momentum move. But Ken Griffin seems to be telling a different story. Now, may I also remind you that Ken Griffin recently got a lawsuit dismissed, a lawsuit in Florida, because of this GameStop report. He relied on it to have the judge dismiss this lawsuit. But what he's telling us in this interview, or what he's saying in this interview that maybe he wasn't expecting a lot of people to hear, is something extremely different. So listen for yourself. Let me know in the comments if you're catching on to what the hell I just heard.
Let's dive right into GameStop. So kind of, if I'm going to start just by, because GameStop was a little while ago, so I'm going to just do a quick, there's a little blurb here on Wikipedia, and I just start by saying I don't represent, by no means do I represent what's on Wikipedia as the truth, but rather just sort of as an expression of kind of the gestalt of the commentary, especially around that time, and just to kind of refresh people who have kind of fuzzed out on the details. So, January 25th, it was announced that Griffin Citadel would invest $2 billion into Melvin Capital, which was the hedge fund that had suffered losses more than 30% on its short positions, particularly on GameStop. On January 28th, Robinhood, an electronic trading platform favored by many traders involved in buying GameStop stocks and options, which, by the way, my firm's involved in, abruptly announced that it would halt all purchases of GameStop securities except to cover shorts, and would only allow those securities to be sold if already held but not sold short. So in other words, Robinhood cut off basically the ability for the retail traders who were torturing GameStop and Melvin Capital at the time from being able to trade. The price of GameStop stock declined steeply shortly thereafter because Robinhood receives a substantial portion of its revenue through a payment for order flow relationship with Citadel Securities, LLC. Many commentators criticize the potential for a conflict of interest where the same entity plays the role of market maker and also participates in the market that it makes. And of course, in this case, also was a major investor in the hedge fund on the other side of the GameStop situation. So I wanted to start, and obviously, please critique any of that's false. But just more generally, I would love to hear, and I know everybody would, kind of from your perspective, basically. Like, from your perspective, like, what happened? Like, what is the true story of what happened during that period?
So, in broad strokes, Melvin Capital was short a variety of stocks that became of interest to rather savvy and sophisticated retail investors who realized that the amount of stocks short was just disproportionately large relative to average daily trading. Mm-hmm. And these retail investors, realizing that there were these unduly sized short positions in the marketplace, started to buy these stocks that caused the hedge funds that were short these stocks to start to incur losses. And, when firms are losing money, they almost reflexively start to cut their own risk. So in this case, they start to cover their shorts, and you end up in this reflexive pattern that as retail's buying the stock, pushing it higher, the hedge funds that are short are covering their shorts, pushing the same stock price higher. And this virtuous circle becomes incredibly painful for the hedge fund managers that are short the securities of interest. And we saw this virtuous circle playing out in the marketplace. And on the day that we invested in Melvin, we thought that this had run its course. In fact, it was very clear in the morning of the day that we made the investment that this short squeeze was apparently dying down. And we invested money into Melvin to take advantage of the fact that a number of their shorts had become very inflated in price, and we expected those prices to revert in due course, and we'd have made a successful investment.
Right.
And at that moment, the world changed. We had the social media landscape with some very important influencers really lit up on the story of GameStop as being a stock to get long and to ride to the moon.
Yeah.
And Melvin continued to cover their short very aggressively over probably the next 48 hours, give or take. I can't remember the exact timing of this. Now, ironically, I'm almost certain that Melvin had covered their entire short before the 28th. In fact, they put out a press release, and the press release would give the exact timing of it. I don't recall that off the back of my hand, but I'm pretty certain that by the time that Robinhood stopped trading on the 28th, Melvin had already covered their short and moved on.
And basically just taking the losses would be the way to think about that, right?
Yeah, they'd taken their loss and they moved on.
Yeah.
I mean, part of what good risk managers do is when they're wrong and they can't understand what's taking place in the marketplace, they take it on the chin, they take their loss, and they move on. Now, Robinhood had a distinctly different problem than Melvin had. They had a problem of too much success. Robinhood had opened accounts with millions of retail investors who, seeing this price dynamic playing out in GameStop, seeing some of the really important influencers in financial markets advocating the purchase of GameStop, we saw an absolute deluge of retail buyers of GameStop unlike anything I think the markets have ever seen before. The problem this created for Robinhood is this very concentrated position of buying required them to post good faith margin with the clearinghouse that everybody on Wall Street uses. And I believe that good faith collateral requirement was order of magnitude $3 billion.
Yeah, that's right.
Of cash.
Yep.
And Robinhood simply didn't have $3 billion of shareholders' equity to draw on to post that margin. And so, because of their incredible success, they needed to restrict trading at that very moment in time where I'm certain they would have wanted to continue to trade to gather the revenues associated with trading, but they couldn't because they had to let some of those purchases work their way through the settlement cycle to release the demands for cash collateral. And of course, as you know, Robinhood was out trying to raise capital at that moment in time to generate more cash to give them the flexibility to make the margin calls that they had to make.
Yeah, and in fact, you may know our firm participated in that round, in that sort of injection.
And I'm certain that was a successful investment for your firm.
Yeah, that was good. There's a couple of kind of claims that have kind of went viral around that time that I think probably are still kind of still circulate around. So yeah, one is this kind of idea. So this idea that on the one hand you've got this relationship with Melvin Capital where you're now a big investor. On the other hand you've got this relationship with Robinhood, where they get a lot of their revenue from for payment for order flow through through your market maker. And so there's this perception developed that you're kind of sitting in the middle of this web and kind of pulling strings. And then there's this kind of, shadowy consortium or whatever they call it in the background. And they're issuing this overnight demand for money. And that's, presumably like somehow rigged up by Wall Street. So like, how do you kind of process through, like, like what was your reaction to kind of finding yourself in the spotlight on that kind of thing? And how do you kind of process through trying to explain to people what the reality of the situation was?
Well, I have to say that processing conspiracy theories is not one of our core competencies. Mm-hmm. So we were a bit slow out of the gate to dispute this ridiculous set of claims, just given like we don't find ourselves in the middle of conspiracy theories very often. So as a large market maker, in fact, the largest market maker in the market in late January, in GameStop, in AMC, in the other meme stocks, we were very interested in seeing the continuation of trading both buys and sells. One-way flow is a really difficult proposition for a market maker. Mm-hmm. All you do is you've got one-way flow. So if people keep selling you stock, you keep accumulating inventory. What are you going to do? You make your money as a market maker from the bid-ask spread of buying and selling, getting into and out of a security over the course of a day. Mm-hmm. So we, as a market maker, were the largest market maker in this period in late January because of our operational capacity to take on the operational risk and capital demands that were inherent in this incredible increase in participation by retail investors. Mm-hmm. So in contrast to Robinhood, we had the financial strength to meet our collateral calls. We had the operational bandwidth to meet the demands of the marketplace on our business. Mm-hmm. And then with respect to Melvin, as I spoke about it earlier, mm-hmm. Their short in GameStop was, to the best of my knowledge, like already gone or virtually gone. It wasn't even in our minds on the day of the 28th. Like, okay. Didn't even think about it. And so the fact that people made that connection ex post was certainly not a connection that I'd made a priori.
Got it. Right. So you weren't sitting there thinking we have to optimize the value of this investment. We just made it in Melvin Capital.
No.
Okay.